Hey guys, what is going on? Welcome back to the channel. Again, I want to thank everyone for your support on the channel. All the viewers, all the subscribers, immensely appreciate the support. Today, I thought I would do another viewer requested video, this time talking about different reasons for jumping into a stock. That is, why should you buy into a stock, either a new stock position, establishing a new position in your portfolio, or adding capital to an existing stock in your portfolio. What are some good reasons to do that? So I thought I'd go through 5 of the best reasons that I have found in the literature, quite a few different perspectives, but I think these will be 5 of the most important reasons to at least kind of focus on when jumping into a stock, or at least thinking about. The other question I want to kind of answer for another viewer is some good literature about investing. One of the best pieces of literature that I read was a little bit older. It doesn't apply to every single investing opportunity, especially in today's market, but a book called The Intelligent Investor by Benjamin Graham. Very good book, a book that Warren Buffett often cites in his financial talk. So I thought I'd kind of take some quotes from that book when talking about the 5 reasons in which an investor should jump into a stock. That is, establish a new position in a stock or add to capital that you already have in a particular stock. So the first reason, and these aren't in any particular order, the first reason would be that your target price is met. That is, the stock price or a stock that you're looking at meets sort of a price that you have predetermined. A good quote from Benjamin Graham's book is, "A stock is not just a ticker symbol. It is an ownership interest in an actual business with an underlying value that does not depend on the share price." So the important thing about this particular quote and the target price is that a stock is simply what an investor is willing to pay for a company that has nothing to do with the underlying value of the company. Some companies are overvalued, some companies are undervalued. And if you can buy or pick out those companies, if you can identify those companies that are undervalued and jumping into those, that would be a very good reason in which to jump into a stock. So really based on research that you've done and a stock is kind of trending down to your target price, that's when you can jump into a stock. Again, there's no magic formula for determining that. It really depends on research as well as what you think that you would be comfortable paying for a stock. Again, the stock price has nothing really to do with the value of the company. There's a number of different metrics you can take a look at. Price to earnings, I've talked about quite a lot in my prior videos. It's very easy to understand how much is an investor willing to pay for a stock for every $1 of earnings, and that is the PE ratio, price to earnings ratio. And there are quite a few different metrics out there describing how expensive a stock is compared to its underlying value. So that is the first reason that your target price is met for a particular stock. The second reason is that there is a market or sector correction. We've kind of seen that in the stock market over the last month or so. And a good quote from the book is that the market is a pendulum that forever swings between unsustainable optimism as well as unjustified pessimism, which will be the third reason we'll talk about. So if there's a big market or stock market correction within a sector or within a particular stock, or as the market drops as a whole, prices of stocks will drop. And again, the underlying value doesn't really change that much. It's just simply what an investor is willing to pay or what the market is willing to pay for a price of a company. So when that happens, you can definitely jump into stocks with the idea that these stocks are now on discount because really the underlying value hasn't changed. It's simply the optimism or pessimism in the market that's changed. That's really what the number 3 reason is, the third reason, unjustified pessimism. And this can be really applied to individual stocks. We've seen this with, for example, Equifax after the debacle with the Consumer Reporting Agency losing a bunch of customers' data. There's a large sell-off. But again, the company, its underlying value really wasn't touched at all. There really wasn't anything changing in the way the company operates or is able to make money. It's simply that overwhelming pessimism drove the stock price down well under its market value. And you can see here in the graph, the market value definitely did recover here. So very good buying opportunity. And this happens to a number of stocks. LB is another stock I think this has happened to. But there are quite a few out there, and quite a few that I've talked about in the past. This would also be the basis for contrarian investment strategies, buying stocks when you think they are unjustified, lower than the value of the stock. The price of the stock is well under the value. Again, there's no magic formula for computing the value. Things like PE ratio, for example, can help you out. But it's really a great time to buy into a stock when there is a lot of pessimism in the market. I think auto would be another great example of this. Ford right now has had quite a bit of positive news, yet the stock price is still lagging. So I think this is a very good contrarian play moving forward as well. The fourth reason would be that the stock you're jumping into is going to be a stock that you're going to hold for the longer term. So there's no reason to jump into the stock with a lump sum, with market risk, that is trying to buy into a stock all at once. You can really scale into a stock by using dollar cost or value cost averaging. Again, I've talked about this quite a bit in my prior videos. And a great quote from the book from Benjamin Graham as well, The Intelligent Investor, is that invest only if you would be comfortable owning a stock, even if you had no way of knowing its daily share price. Again, that's what underlines dollar cost and value cost averaging. You're looking at a time frame of many, many years. So if the price is going up or down in any particular day, you're not really worried about that because you are investing in a quality company, again, a company you identified as a quality company that you would be comfortable holding over the long term. So you don't really have to worry about the share price fluctuating in the short term. You simply put money in on a regular interval, and at the end of 20, 30, 40 years, you have a very good investment to show for that. And the final reason here would be fundamental analysis. Another good quote from the book is that a stock investor is neither right or wrong because others agree or disagree with him. He's right because his facts and analysis are right. So really, depending on what type of technical analysis you are using, fundamental analysis, really this is a whole topic in itself. There are some true believers behind this. There are others that think this is kind of nonsense because if it did work, you can simply engineer computer algorithms to do this automatically for you and make quite a bit of money, which has not been shown to be able to be done at this point. But again, looking at, again, a number of variables like the price-to-earnings ratio will definitely help you out and give you some insights into whether a company is at the appropriate value or not. And really, all of these 5 buying decisions come down to, is the price of the stock in correlation with the value of the underlying company? Lots of times, there's a great opportunity to jump in because the value of the company is well above the price of the stock. Other times, it's vice versa. And there is a lot of optimism in a stock, but it's really not that valued. Some good examples of this would be Ford. There was a recent publication that came out, a news article that said Ford's truck business alone is about twice the price of the current stock price. So you can see that company is probably well undervalued, either pessimism in the market or the stock has fallen out of favor for investors for whatever reason. Another one that is sort of overvalued would be something like Snapchat. When the IPO came out about that stock, and again, I have a few videos describing the IPO behind Snapchat. It was well overvalued. A lot of optimism about the stock, but it really had no underlying business operation to make profit. Because of that, the stock price has definitely fallen off over the last 6 or 7 months of trading on that stock. So, again, really all of these come down to the underlying value of the company versus the price of the stock. And again, the 5 different reasons: your target price is met, there's a market sector correction, there's unjustified pessimism about a particular stock or even about a particular market segment that you want to scale into position with dollar cost and value cost averaging, and you want to use some fundamental analysis as well. It can be as simple as PE ratio or the much more complex fundamental analysis like technical analysis that can help you kind of gauge the price of the stock, whether it is a good time to jump into a stock or not. So those are the 5 reasons that I have identified that I think any investor should know very, very well, and at least at some level take into consideration when jumping into a stock. So let me know if you guys agree about those. Let me know if you think there are better reasons to jump into a stock, excluding the 5 that I talked about. Please let me know. I'm always looking for your guys' opinions and new things to read up on. So let me know either way. And again, if you guys have any questions about this video, other videos, please let me know in the comment threads down below, and I'll do my best to get back to you guys as quickly as I can. So not to make the video too long, I'll kind of end it here. Again, if you guys enjoy the content, if you guys enjoy the video series, feel free to like, share, and subscribe. And until next video, we'll see you then.